Yeah. The last in the quant is primarily on this technical analysis. Probably this is a separate space altogether, right? People specialize heavily only on the technical analysis space itself. So there is that much of scope in the world of technical analysis where the focus is primarily on the number game. The focus is primarily on the stock price movements. Generally, what most of the broking firms do using charts and using some charts, understanding patterns, and then making your decisions of buy and sell kind of stuff. That is what is the world of technical analysis, right? And probably when as a financial guy, technical analysis is just a supporting tool. Major focus is on analyzing the financial statements of the company and making a kind of investment decision, whereas technical analysis is more for a short term trading kind of a standpoint. People depend a lot on technical analysis, but if it is more from an investment kind of a standpoint, the focus is more on fundamental analysis, or typically what any financial analyst is, or any CFA would end up doing as a part of the profile. Fundamental analysis. So technical analysis just for understanding a chapter has been introduced, but nothing more than that. After the level 1, there is no mention of technical analysis anywhere else. So it's just to understand. So the number of questions also would be pretty minimal, though the chapter is slightly long in size. The questions and the focus may not be that heavy on that. So with that as a base, if we get into it, it's a simple. Here we don't understand which company, even without knowing what company is it, I can come out with my buy sell decisions. So how did that company perform? Is it generate? Did it? Is it? I mean, does it have any issues in the political world, or does it have any issues with financial statuses? We don't look at all those things. What we say is history reflects the future. Whatever are the stock prices in the past, probably by just analyzing those patterns and those trends, we would like to predict for the future. That is what is simply the world of technical analysis. People plot charts for last 5 years, 10 years, observe some kind of patterns in the graphs, and they say that the same pattern could repeat again. Whatever are the patterns, some identifiable patterns, they call head and shoulders pattern, they call cup and handle pattern. Whatever are the kind of shapes that are being observed, they try to correlate it with some event. Okay, during this time this shape has come up, or for every 6 months this shape is repeating. And probably when two heads come out simultaneously, after that the stock price is going to fall down. So it is like just an why it is falling down, there is no answer in technical analysis. This is the pattern. Basically it plays with the behavior of the investor, takes the collective behavior of the investors. So because human behavior may not change, see, in a difficult time, or in some specific times, human behavior always reacts in the same way. Whether it is your old generation or new generation or whatever is the generation, that is the basic assumption which technical analysis goes with. It's a purely a behavioral related way of investing rather than a financial related way of investing. Right? It's a non-financial guy's perspective. So basically, it's like, okay, when it has gone up 2 times, there is a chance that it will fall down. Probably it may not have fallen every time. 75% of the times it might have fallen, 25% of the times it might not have fallen. But still, they may come out with a conclusion. This is one of the patterns. Whenever you see two kinds of peaks, you will observe that the stock price will go down. So based on some of the patterns, so like that, there are hundreds and hundreds of patterns which people have identified, and based on that, people are doing the trading, right? So the prime thing is on studying of the market trends and patterns itself in a graphical kind of a format, and they are very much applicable if that security is freely tradable, no restrictions, right? Sometimes I cannot sell more than this much, right? If the price goes more than this much, the trading is stopped. If we have these kind of restrictions, right, or quantity wise, I cannot sell at any point more than this much quantity. In these cases, there will be a small obstruction to this technical analysis. But wherever it's a free market, because it's a behavior, probably some investors will say, oh, the price has already gone up, let's sell it off. While at the same time, some other investors may think, yeah, it's booming, so let's buy it now. So it's that collective behavior is what typically the technical analysis is presenting. So basically, it doesn't talk about why something has occurred. It only talks about what will occur in this scenario, right? Probably it's like studying so much of historical data, so much of historical pattern, and based on that, trying to see what is happening after this pattern has come up. After some pattern has come up, what has happened? And probably assigning probabilities and all those things and coming up. That's the reason I think it was included in quant for us, right? Because of something going up, something going down. Though we don't do any kind of big calculations as a part of this exam, but typically because of that assignment of the probabilities and all those stuff, there is an inclusion of this into the quant. So some of the key beliefs that it goes with are trends and patterns repeat, right? Even in every case also we see, even right from the songs and melodies also, the old ones are getting remixed and repeated. So there is a lot of influence of the past on the future every time, whatever may be the generation. So even the belief is with respect to prices also, the patterns are more or less kind of repeatable. So the more you understand patterns across multiple companies, across multiple time periods, it says probably you can use that information to do the prediction. And human behavior, the another assumption that clearly it makes is human behavior is similar across all the periods. Not everyone is fully aware of investing, right? There is a rational behavior, there is an irrational behavior. Just because my friend said buy this, I'll buy it. So, or just because someone else said that this is going to grow up, I'll invest in that. I may or may not use my own evaluation tool. That exists in the past, even in the future. Though the volumes grow, number of people investing grow, the percentages knowledgeable versus ignorant are probably the rational versus irrational behavior, that proportions will still continue. That is what is the basic premise which the technical analysis goes with. And so it is a reflection of the collective sentiment of the market, and it says the markets are not fully efficient. So you can actually take that advantage of some level of inefficiency that is existing in the market for a short periods. Inefficiencies means probably chance of making riskless profits. So that is existing. So probably if you do this kind of short term analysis based on the psychology, based on the behavior, you may try to make some abnormal profits in the short term. That is what is being driven by this world of technical analysis. And as I said, in technical analysis, I don't need to even bother about what company I am analyzing. I just need the data for the last so many years and a graph for that. Even without knowing what is the name of the company, I can do my technical analysis decision. Whereas when I am doing a fundamental analysis, I require what is the company, in which industry is it operating, last 5 years or 3 years or whatever is the number of periods, annual reports I require, financial information I require, management, who are their management. It's a big long process, because there the intention is from an investment standpoint. How good is this company for investment purpose? What are the credentials of this company? Whereas in short term, it's a game, right? So we are so the technical analysis is more from a very short term standpoint. Intraday trading is what goes heavily with technical analysis, or probably for a few days. But anything for more than that, we are calling it as investing. And we use fundamental analysis itself, where we see what is its true price, right? In buying any of the things, right? Probably it's like this. Probably if my intention is buying a product, I analyze 200 things before I invest in that, right? Probably buying a laptop, I look at 200 items and even what would be its true price. 40,000 is good for it. He's charging 45,000. So probably I may not buy it. Probably you come out with your own evaluation mechanism of 45,000 or 40,000. Probably what is the RAM, what is this, what is this. You have your own evaluation mechanism to arrive at that. Anything you buy in your real world, right? Even when you are investing something in a CFA exam also, there is a calculation that might have gone behind it, right? So that is what we are calling as fundamental analysis. Whereas when I am talking of technical, let's say I want to rent a laptop, very minimal things I look at. Anyhow, I have to pay whosoever is giving me for less rental. Probably that is the guy whom I would be preferring, at least the basic functioning happening, and giving me for a lesser rental. So there the kind of evaluation mechanism is completely different. And here the evaluation mechanism is completely different. If I am looking at something for a very short term purpose, the way I look at it is based on some patterns or something. And if it is for a long term, I look at the consistency. Right? So that's the difference between your technical analysis world and fundamental. In technical, we don't even talk, we don't talk about inputs that drive the output. Right? The performance of the company is what drives the stock prices. But what we are saying is just observe the stock prices and not what is driving them. Whereas in fundamental analysis, our focus is more on the inputs. If the inputs are strong, obviously the output will be strong. That's our assumption in fundamental analysis. Work on the inputs which drive the stock price. Whereas technical analysis says whatever are the inputs, let's observe the output. Right? Probably another better example I can recollect in this case, if you have to decide probably joining a good MBA, right? Just using a vague or probably a better relevant example. Let's say you want to choose a B school to join an MBA. When I am using technical analysis, my intention is just the output, placement, average salary. What was the average salary for last whatever periods? What are the salaries of each of the people? Join. Right? Make a decision based on that aspect. Whereas when I am doing a fundamental analysis, I do much more than that. Okay, what is the worth of what is the curriculum? What is the worth of the faculty? What is the worth of peers? Right? What kind of people are joining that kind? So there is a lot more. Probably there the intention is, if this is strong, probably the output will still be stronger. So that is more of an investment decision. We observe the inputs which drive the output. Whereas in case of technical analysis, I just observe the output and do some kind of manipulations and churnings and calculations on that output to take my investment decision. That is the world of technical analysis. So some more things, especially where financial statements are not there. Let's say we are talking of commodities or currencies. There's no, it's not a company. There's no financial statement in place. For these kind of stuff, technical analysis is better. But for a stock where both of them are possible, I mean, financial statements do exist. Some dividends. There are so many things that are happening out of it. But when I talk about, let's say, potatoes or any gold or anything, right? Gold can still be looked at as an investment, but probably an agri commodities like a potatoes or something, wherein I cannot talk about a financial statement associate, or even for a gold as a commodity, there is nothing like a financial statement associated. So there is no way for me to do an analysis except the fundamental analysis is okay. What is the possibility of demand and supply associated with gold? Some kind of analysis that way I can do, but majority is the price specific itself. So for those kind of elements like currencies and commodities, technical analysis is used very heavily. Though for the stock markets also people use it very heavily, right? Probably there is an alternative in stock market, but there is no other alternative when we talk about the commodities or the currencies kind of a market, right? I mean, you cannot develop models which can say what is the true value of currency, right? So it's more of a trading kind of an aspect itself. So for those kind of entity, it is much better. And yeah, as I said, one major assumption is it takes both the rational and irrational behavior of the investor, assuming that the human behavior keeps constant. And it also says that any price, it moves in trends. It doesn't go like one day up, next day too much down, the other day another too much up. It doesn't fluctuate that widely. There is some kind of a trend that goes. Probably if some upward is there, probably a few days it will be up itself, and again it may go down. So that's the kind of an assumption that technical analysis is making, and it does not talk about what causes the change. It says change is occurring. Just like what has caused the placement, no one is bothered. Is the placement there or not? So why did the placements happen? Why did the placements not happen? No idea. In a technical analysis, right? So that's the and from there, if there are some constraints on free trading, technical analysis will become weaker, because it should be freely, as much as buying, as much of selling should happen. Only then it is more and more appropriate. And in illiquid markets where I cannot sell when I want, right? Probably if I say a bond, if there is a 1 year lock-in period for that, right? In this 1 year I cannot sell it even though I want it. Those are called as, or if I want to sell it also, I have to sell it at a lesser price. Let's say real estate. I want to sell my house. Probably I may not be able to sell it at the price which I want. I may have to compromise on the price and sell it if I want to sell it immediately. Those kind of markets are called as illiquid markets. Because of not availability of the buyer or of the counterparty, I am forced to do it at a slightly lesser price or slightly higher price. That is what are called as illiquid markets. So where the tradability is not frequent, we cannot use the technical analysis at all. And let's say we are, because this is more of a trend analysis kind of stuff. Past what has happened, I'll use that for the future. Now, so if some new trend is observed, I have to wait for some time to establish that trend and then only respond to it. Right? Something should have happened in the future to use, in the past to use it in the future. Right? So there is a time gap. Some time is definitely required to identify the change. Right? Unless it is observed in 5, 10, 20 different times, I cannot create it as a theory and then use it. Because there is no science here. It's only observations. Observations of the patterns and then documenting them. This will happen if this pattern is observed. Right? And so the charts and graphs, the interpretation is completely subjective. Right? How you interpret is different from how I interpret that. Right? Probably when we are doing a fundamental analysis, it's a calculation. Based on some assumptions, we are doing some calculation. So if the assumptions are same, probably the calculation should be the same there. Whereas here it's not the case. The chart, how you interpret it, it's going up, it's going down, it's up to you to interpret it. The same chart, but how you interpret is completely different, and it does not talk about why. So especially when there is a very big drastic change in the economy or something, technical analysis fails drastically. As long as there are small changes kind of stuff, probably, and that's where we are saying for short term purposes, right? As a simple thing, it's nothing but we are using the past patterns to do some kind of decision for the future, right? Now, so for this, people plot different kinds of charts. There is a line chart. This is what we are calling as the line chart. Here the focus is each and every day. The dates are taken on the x-axis. For each and every day, the closing price is plotted. So this will tell me, okay, some kind of shapes are coming out. Probably two heads kind of thing is coming out there, two tops. So that's one pattern. They call it as double tops kind of a pattern. So the moment I plot some chart, I may see, okay, overall it is looking like the price has gone up to certain extent. So just by looking at the graph, they come out with different kinds of interpretation. So technical analysis is nothing but interpreting the charts, right? So that's one aspect. So people plot line charts. Sometimes they plot what are called as bar charts. This is a bar chart. For each day they plot something like this. 4 elements. In a line chart, only closing price is plotted for each day. Whereas in a bar chart, 4 elements are plotted for each day. The low and the high, the low price, the high price, both are joined with a line. The left side is open price. What was the starting price for the day? The right line is closing price. So if the close is above the open, if the right line is above the left line, then it is like there was a gain during the day. Right line is below the left line, then there is a loss during the day. So for every day, all the 4 elements are plotted as a part of the bar chart, right? But sometimes it becomes very difficult to interpret because how many are to the left, how many are in how many days up is, the right is above the left, in how many days left is above the right. Visualizing it becomes more and more difficult. So from that standpoint, another charting tool has come up which will take all 4 of them into consideration, and an improvised version called as a Japanese candlestick. This is a Japanese candlestick kind of a chart. Again, for every day, a stick like that is being plotted, right? And in some cases, it is white. In some cases, it is shaded. Simple interpretation is, if it is white means close is above the open. Shaded means open is above the close. Sometimes it even shows green and red. So different software tools, they use different kinds of plotting mechanism, but the most generic form is a white, a clear kind of stuff means open is lesser than the close, which means it has closed at a higher price during the day. And if we are talking of the shaded one, the open is above the close, closed at a lower price compared to the beginning. And high and low are the same way even in case of bar. What was the highest price during the day, lowest price during the day, and in the middle. So for every day, even that kind of thing is plotted. So people can directly looking at it, oh, how many shaded regions? These many. So for the last few days, there were all shadeds only. Or probably the gap between open and close, is it narrow or is it wide? The size, the width of the candle will tell me. The height of the candle will tell me whether the gap is narrow or it is wide. So just by looking at that chart, people can make out what is happening. So sometimes we can look at a bar chart, sometimes we can look at candlestick kind of a presentation. Then this is a slightly unique kind of a chart. This is actually called as point and figure chart. This is slightly unique compared to the other charts in the sense, in the other charts we see the time on the x-axis for every day. For every day the price, probably one price or four prices. For every day there is one plot that is coming up. Whereas here there is no x-axis. Here there is no time on the x-axis. All it goes with is, it starts with one number, right? Probably today's price, right? Let's assume that the today's price is 80. Let's assume that the today's price is 80. So there will be some level of definition. It only talks about the change in the price. When are the significant changes in the price occurring? It does not bother about on what day. How many times the price has changed significantly. So as long as there is an up, it will be represented by crosses in one single column. The moment it goes down, it will be represented by circles in the next column. Circles are down, crosses are up. So probably here it will define what is the definition of significant change. Is it 3 rupees up, 2 rupees up? What is the definition of significant? So on any day where there is a change of 2 rupees or more, if I define that is my significant change, on any day where the change is more than that much, right? Let's say it is going in X. As long as the price is going up and up, it does not bother. Down, even if it is down by 1 rupee, if I set 3 rupees as my significant change item, as long as it is going up, no issues. Down, less than 3, no issues. The moment it becomes more than 3 down, it shifts into the next column. That may happen in 1 day, that may happen in 10 days, that may happen in half a day. So there is no time angle there. Again the same. 3. As long as there is no up more than 3, it will still continue there. On any day when there is a more than 3 rupees up, shifts to the next column with the X. Now if you see here the pattern, let's say it has gone 80, it started going up, 81, 82. So up to 82 we have marked the cross. Suddenly let's say the next day the price has fallen to 79. We have defined, let's say 3 as the changing point. It has fallen to 79. So from 82 falling down to 79 is like a drop, is like a significant change. So up to 79 in the next column you will see circles. If it falls below 79 still, the circles will continue even up to 78, 76. Now let's say the price has gone up the next day or after some days, it has fluctuated between 79 and 82 only, because anything more than 3 only is significant. Until that time it continues in that column itself. Now suddenly let's say it has gone up to 83 or 84. Then in the next column, suddenly it changes to the next column as an increase column, and it goes and plots up to this point. Let's say 82.5 or whatever. Then again, if it is fluctuating again between 79 and 82.5, it continues there itself. So like that. So what does it tell me? 2-3 things. One, how many significant changes have occurred during the period? Significant move from up to down, down to up. So probably if I can count the number of columns, there are number of significant changes. 1. 2, which ones are more? Is it circles or X's? If circles are more, it shows that there is a lot of downfall. in the price. If X's are more, it shows that there is a kind of upfall in the price. It does not talk about how many days. That's the reason point and figure chart is slightly different from the typical line chart, bar chart. So it does not have any time on the x-axis. It's only the column. So new column gets added only when there is a significant change. So if, every alternate column you see X's and O's. Because as long as that same pattern is continuing, it will be in that same column. Only when there is a big reversal happening, it goes into the next column and vice versa. Right? Then, one more thing which people look at in this context is, there is a concept called relative strength analysis. It's as the word itself is saying, right? The way which, let's say I have two securities. Which one is performing better compared to the other? For that, I do a relative strength analysis. So it's nothing but whatever is the performance of the first with respect to the second. If the first one, if the price, let's say the price of the first by price of the second. Let's say today one stock is at 200, the other stock is at 100. Whereas tomorrow, let's say this has become 210, this has become 102. This is what I am doing as a relative strength analysis. Earlier, the relative strength of the first to the second was 2. Now it is 2 plus 2 point something. So which means the second one has performed much better compared to the first one has performed much better compared to the second. Numerator higher than the denominator, the first one is performing. So if the ratio increases over time, the stock is outperforming the benchmark. The numerator is outperforming the comparison one, which is the denominator, and vice versa. So this is a very, again, a straightforward, simple formula kind of a mechanism. Instead of looking at it in terms of price, we are looking at it in terms of a ratio. Then we also talk about volumes in the technical analysis, not just the price. These are the only two things which we see: price, volume. Price is the most significant stuff. Along with the price, we also focus on volumes. Basically, what people talk of is, for any price increase, if it is added up with a volume increase, volume is more number of people. More number of people, the number of people are increasing, and the number of purchases are increasing, and the price is also increasing. It will still say that there is some kind of trend that is going to continue. But if the price is increasing, but the volumes are falling, which will indicate a reversal in the trend. See, the price is going up today, but the number of transactions are going down. See, even in a normal market, you can think of it. If more and more transactions are happening and the price is going up, it means lot of people are positive still. See, even now person is buying, means he is expecting that the price will still go up. Correct? Let's say you are buying something today, even after the price is already high. You are having an intent, a lot of people are, so like that, so many people are buying even if the price is high. It means there is still a thought process that the price is still going to go up. But if the volumes have gone down, the price is high but not many people are existing as buyers, probably you may observe that the reversal is going to happen. That is how people combine the price with the volumes in terms of analysis. Rising volumes can indicate the continuation of the trend, whereas falling volumes will indicate the reversal of the trend. Any trend, if let's say the price is falling, lot of people are selling, it will still continue, it will keep falling. Right? People are selling means there is a kind of negative outlook on the price. But if the volumes are falling down, not many people are selling, suddenly there could be a buy. So there could be a scope of reversal starting up. The price will take a U-turn. That's a one common, that's one very important conclusion that people brought out through this technical analysis. So some of the terms we need to be comfortable with is the trend. For a technical analysis, the trend is more like uptrend, downtrend, no trend. Uptrend is the prices are going up, down is going down, no trend is more or less flat. And the better way we define the uptrend is highs are going high, lows are also going high. Both lows and highs, both of them are going up like this. If we see, the highs are going high, and probably, with the exception of this, all the low points are also going up. Not just the highs, both lows and highs, both of them are going up, is an indicator of uptrend. Both of them going down, both the highs as well as lows, when both of them are going down, we call it as a downtrend. And the typical way people draw the uptrend line is they join all the lows. The tools, when they typically draw the uptrend line, trend line, they join all the lows and call it as uptrend line, because it's not the highs that we have to check in case of uptrend. Even the worst is still higher than the previous worst. That is what is an indication of uptrend. So major focus is given to the low in case of uptrend. The low is better than the previous low. That is when we call it as uptrend. The high is lower than the previous high. That is what is an indication of downtrend. So to plot a downtrend line, people join all the highs. All the highs and see whether it is coming down. To plot a downtrend, uptrend, they join all the lows and see if that is going up. So that is one context we have to see in case of the technical analysis. Any technical analysis chart which we see, wherever sometimes people talk about an uptrend or a downtrend kind of a line, our intention is if it joins all the lows, we call it as uptrend. Joining all the highs, we call it as a downtrend. Couple of more terms that we have to use here is support and resistance. Support is something like, let's say if the price is going down, down, down. Suddenly, some people will start thinking, the price has reached already a good low. Let's buy it. Right? Lot of, if the price has gone down, 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 there is again some set of community always. That's where we are talking of human behavior. Right? It is observed that once it reaches some down, there is a possibility that some people may find that it is cheaper to buy now. Right? Cheaper to buy now. So they may think of buying it. Because of that buy, what happens? The price will start going up. So a downfall is prevented for some period, because that number of people may not be too large. Some set of people would be getting into it. So that is why we are called that part which is more for a short period, that downfall is being obstructed or prevented, is what we call as a support point. So it will become cheaper it looks cheaper for some of the buyers, and they get into the buying kind of an activity. And of course, once the price starts going up, again the volumes and all, they keep increasing, and probably the price will start mounting up. The same is the opposite with the resistance. Any price that is going up, right? Some people may feel, oh, this has reached all-time high. Let's sell it right now itself. Right? Probably we don't know whether it may go up more than. So there is always some set of population who think like that. So because of that, they initiate a selling process. So the upward movement is blocked, and that is what we are calling as resistance level. Right? So whenever the upward continuous upward movement is blocked for some period, we call it as resistance. Whenever the downward flow is blocked for some period, we are calling it as a support point. And even people have come out with one more observation. In case the resistance level is breached, right? Probably what are we talking about as a resistance? Okay, the upward trend halted, so there is a downward trend, right? Again there is an upward, because this is a very small time, price has fallen up to here. Again there is an upward trend that has started. Again I may observe some kind of a fall, because again once the price reaches this level, some more people may think, earlier we missed out on this opportunity, so let's sell off this time, right? Probably by this time they might have observed, oh, the price has fallen after this, so probably this time once it touches that point, let's utilize the opportunity. So you will find once or twice that same pattern occurring. Now let's say here again the volumes will be probably here, if there are X number of people who got into it, here probably X minus something will be the number of, so volumes may decrease. Right now what may happen, now this is what we are calling as resistance level, because the point above that the price is not going up. That is what we are calling as the resistance level. Now let's say if that resistance level is breached, so probably it has come here, instead of taking this turn, probably it has gone up. That is what we mean by resistance level being breached. Now again the theory is saying that if the resistance level breaches and the price starts breaking free, that same line will become my support line. That same line will become the support line. So if the resistance level is breached, the same line will become the support line. Probably after it has gone up by certain extent, it will start falling. The moment it comes up to this level, that fall is prevented, and again it will have some kind of buying there. So that's a typical theory which people have observed. That is what they call as change in polarity principle. In case the resistance is broken, it is observed that the same line will become the support line and vice versa. Now, some of the most common patterns which they have introduced for us, simple way, I mean, we don't need to get too much in depth into it, but the two common patterns that have been highlighted to us are the reversal patterns and the continuation patterns. Reversal is probably if there is an up movement, it will become a down movement or vice versa. They are called reversal. Continuation is it continues the same pattern. Now, so the current trend will be ended in case of reversal pattern, and a new trend and the opposite will happen. There are some names that are being given to it. This is head and shoulders. A head in the middle and two shoulders to the both the sides, right? So in this also, if the volumes decrease from here to here, it shows that after this the prices are going to go down drastically, right? Again, in this head and shoulders pattern, there are some names. This is head, these are shoulders, so it should be more or less the same in height. Head should be slightly more, shoulders, and probably this is what is being called as neckline. This is what is called as a neckline, shoulder and then a head. So what it says is, if at all, this is one again, no logic, only observations. Once the volumes drop, it shows a reversal in the trend. So it does not go up anymore. It starts falling drastically. And the same thing is with inverse head and shoulders. This is inverse head and shoulders kind of a pattern. Even then also you see that after that it does not again go back like this. It starts going like this. Right? So that is what we are talking of breaking out. Now what it says is, again a numerical present here. What it says is, in case of this kind of a reversal, what is the price to which it falls? So for that they have come out with, let's say the head is some 80 and the neckline is, let's say, 60. Right? The neck is 60, head is 80. Shoulders, whatever they are, slightly 65, 70, whatever they are, both the shoulders. Let's say if that is the case, what this says is the drop when it occurs, it will occur by 20. 80 minus 60. The drop occurs by 20. So you can expect that the price will drop up to 40. From 60 it will drop by 20 units. So you can easily expect that the drop will go up to 40. If you want to take a buy decision, you do it at 40. That is what is again a common pattern which they have observed from a behavioral standpoint. So from a head and shoulders pattern, there is one numerical like this. You have to be comfortable with this. They give the head, they give the neckline. They ask you to find out probably at up to what extent the price can drop. Which they have given a calculation. The target is nothing but the neckline plus neckline minus head. Neckline is 60. Neckline minus head is minus 20. 60 minus 20, 40. Whether it is head and shoulders or inverse head and shoulders, in both the cases that pattern is typically observed. Yeah, in that case, in inverse head and shoulders, it will be an increase. So similarly, they have observed two more patterns: double tops, triple tops. But again, logics remain the same. After, let's say, if the volumes are continuously decreasing, it goes the reverse. If the volumes are continuously decreasing, they will identify a reversal in the trend. That upward movement is broken because 2 times it has gone up. So that upward movement is broken and it will go downward. Even this triple top also indicating the same kind. And even the bottoms, double bottoms, triple bottoms. So all these they are identified as reversal patterns. Whenever you are observing these kind of shapes in your data, there is a good chance that the price will go the reverse way. Similarly, they have come out with some kind of patterns called continuation patterns, which are like probably temporary patterns. Like, let's say, you are observing the price more like this. Probably if you see this is more like a triangle. The pattern is more like a triangle. Something going, highs are going high, lows are probably flat or going low. But it is looking more like a triangle, where from a very small gap, it has gone to a very large gap. Or probably from a very large gap, it gets narrowed down. So what it says is, when these kind of patterns are observed, triangles, rectangles, flags, when these kinds of shapes are observed, once that shape is over, for some days that shape will be there. Once that shape is over, the previous pattern will continue. If it has an upward trend, the upward trend, which is like it for a small period, you will find the prices fluctuating widely or prices fluctuating very narrowly. But once that small period is over, again it's the old trend itself that continues. So it's purely coming from the observation of the past data. Right? So these are called as continuation patterns. Wherever the typical, probably it's comfortable that if you remember the names itself, because not too much beyond that would be asked. Right? At least the triangles, rectangles, flags, these are the kind of things which go under a continuation pattern. Head and shoulders, inverse head and shoulders, they all go as a part of the reversal kind of patterns. So that's one aspect that they have identified. And the other aspect is calculations, which is what they are calling as indicators, right? So basically the indicator is nothing but, see, the chart patterns are more like looking at so much of historical data, some pattern is observed, and based on that pattern, I'll think when it will repeat, when that pattern can repeat, and all those things. Whereas when we talk about indicator, on the spot buy sell decision is what is being given by indicators. At this moment, should I buy, sell, hold? Just by looking at the previous prices only, on this spot, at this moment, if I have to take a decision, should I buy, sell, hold? They are all like separate formulas, right? Just like, let's say I'll tell you, they are categorized into 4 groups. These indicators. One is a price based indicator. Other is momentum based indicators, momentum oscillators. Then we also have flow of funds indicators. We'll talk about each of them. There is a flow of funds indicator, there is a price based, and there is a sentiment based indicator. These are 4 types of indicators. Probably the sentiment based indicators are more or less theoretical in nature, right? Probably let's see some of them. So they are gauging an investor activity based on, so they talk about today is the market bullish or bearish. How do they talk about? One is a very theoretical investor polls. I ask experts, today is it going to go up or go down? And based on that, I'll take my decision. So 100 of you telling me go up, 200 of you telling me go down. Based on that, I'll take my own decision. That's an investor poll kind of a mechanism talking about, is the market going to be bullish or bearish? But apart from that, there are some based on the calculations, people will make out whether it is good to buy or sell. One such thing is called as a put call ratio, which is probably we'll discuss more in depth of the words put and call when we talk about derivatives. But as a definition, puts is more to do with selling of your security, and call is more to do with buying of the security. Put option is more to do with selling of security. I mean, I'm discussing it in very brief. Put option is more to do with the selling of the security, whereas the call option is to do with buying of security. So if the puts are more, calls are lesser, put call ratio will be more than 1. Put buy call. Puts are more, calls are lesser, which means sellings are more. In future people want to sell more and buy less, which is an indicator that the price is going to go down in future. More put options lying, less call options. What does that indicate to me? More sellings in place, less buying. The price is going to go low in future. Straightforward. So for every security, I can observe how many puts are there, how many calls are there, and based on that I can look at whether this stock is going to go up in price or go down in price. That's one kind of a quick sentiment indicator talking of today should I get into a buy or a sell decision. Again, there is nothing like I should buy, I should sell. Probably a traditional person in that example, he will think of selling. But a contrarian in the trading world, some set of people are called as contrarians, who act the reverse. So because the calls are much lesser, probably the price is going to go low. He may think this is a good time to buy. So he goes against the trend. So there is nothing called you should buy. We always, whenever we say you should buy, we talk about from a traditional person's standpoint. But from a contrarian standpoint, it's always the opposite. And there is a VIX, which is called as volatility index. This is also published by the exchanges. That talks about what is the level of fluctuation. in the market. If the volatility is much lesser, right, probably it's an indicator of more and more security associated. More and more fluctuations is an indicator of more risk-taking behavior in the market, right? So that is one indicator. 2, margin debt. How do I look at this margin debt? Margin debt is nothing but broker giving a loan to purchase the shares. Margin trading is what is the name associated with that kind of purchase. You are actually taking a loan from the broker to purchase the shares. Broker gives it for no interest for a intraday. The purchase is for intraday. You are buying in the morning, selling it by evening. When will a broker give more loan? If he thinks that the stock price is going up, if he is thinking that it is going up, he knows, okay, let this guy buy more and more shares. He will be happy, I will get my brokerage. But if the stock price is going down, if he gives a loan, probably he may not get back his loan. Because he is not giving any interest or anything, he may not even recover his loan in case the interest levels are, in case the stock price levels are going down. If the stock price is going up, this guy can sell off the share by evening at a higher price. He can refund back my loan. But if the stock price is going down, this guy has to sell off his share at a lesser price than what he has bought. So probably he may be interested in taking a loan or he may not be interested. If everyone thinks that the market is going to go down, why will they take loans to purchase the shares? If they think only if the market is going to go up, then only there is a lot of loan. Oh, let's take the advantage of this short time period. Let's borrow as much as possible and let's trade very heavily. Right? That's the intention typically. But if you think that the market is going down, no debts will be taken. So the quantum of loan that is being taken from each of the brokers, if it is higher, it indicates a bullish sentiment. If it is lower, it indicates a bearish sentiment. Similarly, the short interest ratio, short selling is what again is more similar to margin trading. Instead of buying process, we are talking of selling process. Take the shares from the broker and sell it off. Now, instead of borrowing money from the broker, you borrow the shares from the broker and sell them off. When will a person think of borrowing more and more shares from the broker and selling off? When he thinks that the price is going to go down. Right? If he, see, today I am borrowing shares from you. I am selling off in the market. But I have to refund back your shares. Only if the price goes down, I will buy it back at a cheaper price and refund back to you. So I have sold it, let's say at 120. Right? So I got 120 rupees. Now it has gone down to 100. I bought it at 100, refunded back your share. I am left with 20. So that is what, so if more and more people are showing interest in short, right, it's an indication of a bearish sentiment in the market. If very less people are showing, it's an indication of the bullish sentiment. So just by looking at some of these sentiment indicators, we can talk about whether the price is going to go up or go down. One aspect. The second dimension is price based. What people compute is the moving average. Probably I'll take one data set and drive all these things. That will make things more easier. Let's say for the last 1 year, I have these prices. Now, based on this, I want to take some decision as of today. Today, should I buy this or not? So, okay, sentiment indicators we have already looked at on what. So, probably I'll look at the put call ratio for Infosys. Based on that, I'll say whether it is going up or going down. Or I will look at the margin debt positions that are available for Infosys. Based on that, I'll take my decision of going up or going down. So those are sentiment based indicators. Now, when I talk about the price based, we are talking about two things. One is called as the moving average. What is this moving average is, I take the average price for the last n number of days. So when I say 10-day moving average, I take the average of the last 10 days. When I say 50-day moving average, for the last 50 days. Right? So probably let me just compute. I'll take, let's say, 12-day moving average. And probably I'll take 26-day moving average. I'm taking some averages. Right? Probably the 12-day moving average is what? Probably here I will do an average of the last 12 days. This is my 12-day moving average. Whereas the same thing probably I'm doing it for, so here it is the average of the last 12 days. Like that, let's say if I'm doing it for 26 days, let's say this is the average of the last 26 days. Right? Now, what people look at is, if a small day moving average, which is 12 day. 12 day is last 12 days average. 26 days last 26. If the small day average is higher than the large days average. Right? So this is the average of last few values. If this is higher, which means the last few values are higher compared to the previous values. So it's an indicator that there is an uptrend that is going in the market. If a small day moving average, 12 day is greater than 26 day, because 26 day is the average, probably if I'm looking at the prices 1, 2, 3, 4, 5, 6 up to 30. What is the 12 day moving average? 30, 29, 28 average of those things. Whereas 26 day moving average is the average of 5, 6, 7, 8 up to 30. That will be much lesser compared to the average between 19 to 30. Right? So, which is an indicator of uptrend. If at all we are seeing a small day moving average above the large day moving average, we call it as an uptrend. Otherwise, we call it as a downtrend. So, going back. So, if you go back to our spreadsheet, to our presentation, that is what we call as golden cross. Short-term moving average greater than the long-term moving average. Because it's an uptrend, get into a buy. Wherever you are seeing that the short-term moving average is lesser, now probably you go back to the today's scenario. Go back to the today's scenario. What is the scenario we are observing here? Small day moving average is very high compared to the large day moving average. 12-day average is very high compared to the 26-day moving average, which is an indicator for me to continue the buying. There is a kind. So typically what people do is, the moment it crosses, rather than seeing this much of a difference, probably you see here, right, somewhere here, there is a small crossover. Right, here also this is lesser. Here also lesser, here also lesser, lesser, here it is crossed. Small day moving average just crossed the large day moving average. This is the point I should buy. Probably if you see what is the point, you buy it at 2,498. Today this is the situation. You buy it on 9th July. At this number, on 26th July, you are reaching here. Right? So, whenever you see a small day moving average crossing a large day moving average, at that crossover point from the bottom to the top, we call it as a golden cross, indicates an upward trend. Down, we indicate it as a dead cross. We look at it as a downward trend. It's better to sell. At that point, it's better to sell. That is what is. So like this is an indicator. As of today, what should I do on this? Right? Sometimes the other way which people look at is, yeah, the gap has gone very wide. So this gap may not go up anymore. So better sell it now. You have enough. You got, see, when it is just initiating, right? A small day moving average, a large day moving average, when it has just initiated from bottom to top, it's an indicator of the upward trend. But let's say it has gone up drastically and the gap between the two has gone up very drastic. There is a mindset again, how long this gap can continue like this. Better exit out of it. That's a contrarian view. Enough is enough. Now let's get into the opposite side. Right? So that's the way which people look at, oh, gap is widening. As long now the moment the gap reduces, they do the sell. As long as the gap is keeping on increasing, they continue. The moment gap decreases, they sell off. That's a typical strategy which is being, just by looking at the moving average, if I have to take my decision. Again, this is for a short term, because within no time again another crossover will happen. So it's a very short term kind of a scenario. Sometimes there's a good chance in some number of cases you can make decent profit, just like this example which we have seen. And there is one more mechanism which people observe, which is called as a Bollinger Band, which is nothing but for the same period. If I have to talk about Bollinger Band, they define a range, not just an average. They define a range to this average. The range is based on standard deviations. Again, probably one of the other reason why this is included in quant probably. So the range which is defined, it's a small interval that is built around this 2240 based on two standard deviations. Towards the left, it's like a 95% confidence interval. Two standard deviations to the left and two standard deviations to the right. So basically it's like this number minus 2 times the standard deviation of all these numbers. So probably 2139. 2, the same thing, this number plus 2 times the standard deviation of all these numbers. So what is it telling? As long as today's stock price is in between these two, don't take any decision. No buy, no sell. If it falls below this, buy. If it falls above this, sell. So probably if you see here, now let's say I'm going across. Right? Probably I can put one small formula here. So probably I can say if the today's price is less than this, I may say buy. Otherwise I may say if today's price is greater than this, I may say sell. Otherwise I may say hold. So okay, for that particular day it is saying hold. Now probably somewhere it may show a buy. Now you see here it is saying buy. Right? Probably on this day you get into a buy process. Probably again couple of more days. So probably even if you assume, yeah, you are buying it at 2488. The market price is 2488. Let's assume that you are buying it at 2488. When is your sell? Okay, in some cases, yeah, probably this buy is matching very well with this sell. Sorry? Okay. Oh, the current. On the day of decision, it is see, each one has its own definition. So, I mean, not all of the see where all of them match very strongly. That's like a strong buy or a strong sell for you. Each person, each indicator is a calculation in its own space. So, probably on that day, probably let's see there. I got your point. So, let's say here I will put, yeah, from here I may say if this is greater than this, I may say plus, else I'll put minus. So here I'll put a logic saying if this equal to plus, then I'm saying if the previous one equal to minus, it's like a buy, else hold. And here I'm saying if this is minus, so let's say I'm writing a rule like this. So there's a just a move from one to other. So on these days, probably this is saying hold, and almost on all the days. Oh, so this logic is this one is saying buy, this one is saying hold. Oh, sell and buy. Probably wherever you find both of them giving you more or less similar is when you respond heavily, right? You are almost close to sell here. So different mechanisms have a different mode of computation, and based on that computation we are talking of a buy and a sell decision. So some people they trust some indicators, whereas someone else they go with the some other set. But hardly, I mean, what I am trying to drive here is hardly there are 4 5 points altogether during the year, right, where you can really take your decision. Let's say you are taking a buy point here, probably yeah, this buy here, sell here. 2296 is the buy point, 2470 is the sell point within no time. So sometimes it clicks very well. So probably another few sell points are being mentioned here with no buy point. So there is literally there are only sell points. Hardly probably this is one opportunity which should have been used up. Buy it at 2296, sell it at 2397. Only one day that opportunity was available. So you sell it at 2397, or probably again there are so many other sells only coming, no buys. Probably even if you have missed it on those days, you could have sold on any of these. But still here it is showing me a hold itself. It may so happen that because it is showing a kind of continuous increase itself, it's not giving a kind of a big sell decision here, right? So like that, people do all kinds of calculations and then take a decision of buy or sell. That is what are the indicators. Like that, we also have, let's say, flow of funds indicators. These are also slightly more common. I mean, they are not heavy calculation oriented. right? Basically, if I'll come to the arms index, margin debt we have already discussed. It is a part of the sentiment indicator also. More levels of brokerage, brokerage loans that are available, broker loans that are available. That's an indicator of the bullish or the bullishness in the market. Now, mutual fund cash position. This is one more indicator. See, any fund manager, for him the responsibility is invest the cash. Right? Whatever the fund, whatever the amount pooled from various investors, you invest it. Now, if he is not investing a huge amount, if he is maintaining a large portion in the form of cash itself, right? He is not finding better avenues to invest. He is not buying the shares; he is holding it in the form of cash itself. Is an indicator of bearishness in the market, right? Otherwise, he would have invested. If he thinks that the share prices of these stocks are going to go up, he would have invested in those things and his cash position would have been much lesser. But now his cash position is much higher, is an indicator that there are no good stocks to buy right now. So he's thinking that it's better to hold in the form of cash itself rather than losing money. So it's an indicator of bearishness in the market. And new equity issuance, when more and more shares are coming into the market, right? Generally, more shares come into the market when you think that it is favorable for the equity market. But one more thing we have to see there is, it's the same investors are not going to increase drastically, but number of shares are going to increase drastically. So if they put their money in the new shares, new company shares, they have to pull from the existing company shares and put it here. It's not that the new investors are getting created, right? So, and that too during IPO, there is again a thought process that again we'll discuss about this in our other classes, but there is a simple thought process that IPOs are generally underpriced. The investment banker wants to play safe while pricing the IPO. So generally he'll do an underpricing of that IPO. So again people's sentiment or thinking is, we buy it at a lesser price, very soon it will go up in price. So there is a lot of rush for purchasing those IPOs. And where will they purchase it from? Selling of the existing shares itself. So it may indicate that for some of the stocks, the price for the existing stocks, the price is going to go down, and probably the same money would be redirected into new stocks. Especially if the IPO market is very heavy, these are the kind of things that typically come up. Right? So these are flow of funds where you actually don't do big calculation. There is one called arms index or TRIN. This is also a very simple calculation. It is nothing but, we see in a day, let's say there are 1500 stocks on NSE. How many of them have gone up divided by how many of them have gone down. Right? How many shares? 800 going up, 700 going down. That is advances by declines. We also talk about volume of advances by volume of decline. Volume of the advancing issues by volume of the declining issues. How many shares have gone up? It's not number, it's how many shares, right? The volume of the trade. Volume of that trade for all those up securities divided by the volume of the trade for the down, going down kind of a security. So now in this case, if you get a ratio less than 1, see basically if I do a slight mathematics, advancing issues by declining issues multiplied by volume of declining by volume of advancing. This is what when I do a division there, the reciprocal gets into multiplication. So if this ratio is less than 1, it means the volume of the declining is lesser than volume of advancing. The numbers are very small numbers. Volumes are very big. So we always focus on volumes. Volume of the decline is less than volume of the advance. So there is a bullishness in the market. This is an indicator of bullishness in the market. So arms index, small calculation like this may typically be coming out for you. So this is one more indicator that people use to observe whether to buy or sell. Just on a this is more on a market level basis, right? Not for one single security, complete exchange it looks at. And there are some other indicators that are available for us, which are called as momentum based indicator. These are nothing but based on the price, they compute some formula. Small difference between price based indicators and momentum based indicators is, in case of price based indicators, whether it is moving average or the Bollinger Band, we looked at the price, compared it with some number and then said buy or sell. But these momentum oscillators, what they do is they create some formula on the top of the price such that the number will lie in a certain range. Let's say 0 to 100. Close to 0 means buy, close to 100 means sell. So they create a formula on the top of the price, right? That formula will always lie between a certain range only. That answer of that formula will lie between a certain range. It oscillates in a certain range. So if the oscillation is more closer to 0, they say some decision, more closer to 100, they say some other decision. Or it oscillates around a point, let's say 100. Below 100, some signal, above 100, some other signal. So the calculations are made on those on the prices in such a way that they oscillate between 0 to 100 or they move around a particular value. The most common of those oscillators is the relative strength index, RSI. Very commonly used indicator in the market. See, after doing all kinds of calculation, this value lies between 0 to 100. Right? So 50 is like hold, middle. So up to, and they also say, okay, as long as this value is between 30 and 70, don't disturb, hold. Just like your Bollinger Band itself, but instead of directly operating on the price, some calculation happens on the price and a kind of range is derived. Okay, if that RSI goes below 30, buy. It indicates overselling has happened. Lot of people sold, so it's time to buy. Whereas if it has gone above 70, it's like the price has already reached a decent height, better sell. So it's a very solid indicator in the market, right? If the RSI below 30, people get into a buy process. Above 70, people get into a sell process. Like this, all these, whether we are talking of, let's say, stochastic measures, they have computed, it is computed based on the last n days, let's say 10 days or 20 days, high and the low price. There are three things that are taken here. In the last 10 days, what is the high price? Not today's high, last 10 days high, or last whatever is the days we are taking, last 20 days high, last 20 days low, today's closing price. These are the three things that are considered in that. So what does it say? Today's closing price, did it close closer to high or 20-day high, or did it close closer to 20-day low? Right? Is it very closer to 20-day low, or is it very closer to 20-day high? If it is very closer to 20-day low, probably it's an indicator for me that whatever that low it could not attain in the last 20 days, today it has attained. Better to buy it now. If it is very closer to 20-day high, we'll say, yeah, it's almost, it has touched. Very rarely that height is being touched. Better to sell off. But if it is somewhere in the middle, we don't need to bother. We can keep on holding it. Like that, there is a percentage K line, which is, so the K is actually computed as the closing minus low by high minus low. Today's closing price minus 20-day low by 20-day high minus 20-day low. It's like, let's take an example. 20-day high is 100. 20 days low is 80. Today it is closed at 82. 82 minus 82 by 20. 10%. Which means it is very close to low. 90%. It's very close to high. Right? So if it is very close to low, it's an indicator for me to buy. Otherwise, it's an indicator for me to sell. Right? And rather than that, what people also say is, why only 1 day's value? Let's take average of 3 days. And that is where they have constructed a percentage D line. So today it is 10%. Yesterday it was 20%. Day before yesterday it was 15%. So you take the average of these 3 days for taking your decision. Instead of 1 day, you take the average of the 3 days. So that's where it says moving average of the percentage K, generally a 3-day average. The average of the last 3 days is what is taken. And just like the way we worked on our moving average, small day more than the large day, a buy decision or a sell decision kind of. So same logic you will apply here also. Right? So these are some of the indicators that are available for us. So the indicators as such from a technical analysis standpoint is nothing but they will help me in taking a decision right away. Buy or sell kind of a decision at the spot, on the spot. And a couple of more things that we need to understand as far as the technical analysis is concerned is the usage of cycles. Sometimes people have identified that patterns repeat in form of cycles, right? And some kind of cycles which were interesting to observe is they have identified what is called as a US president election cycle, in which they have observed that the Dow Jones will perform at its best in the 3rd year after the election. Probably it's like, oh, now next elections are going to come, so I need to get re-elected. The typical psychology. We need to get re-elected, so let's pump in as much funds as possible into the industry and the economy. So there is a chance that the whole market will grow. So that is what people started believing. So it's again, why it grows? Okay, you may give your own logic, but data is supporting that. Right? So once the data is supporting, people derive whatever they want. That's the typical way to work out. And sometimes people have even also observed, this is a slight even more vaguer stuff, the decennial patterns. The way they have come out with is, the years which are ending with 5, like 2015, around that, the growth will be much, much higher. But somewhere close to zeros, the growth will be the worst. So probably 2010, right? Closer to that 2010 and probably at 2000. So from this again they do, I mean, it's not again purely forecasting or it's not fortune telling, but still this is the pattern that they have observed in the data. Right? Somewhere towards, so they have gone with the decennial pattern. Every 10 years we see a cycle kind of stuff. Where at like during the year ending with 5, 4, during that stages it's peak. After that it's going to be going down kind. Probably from 2010 up to 2015 it's going to be much up, peak. Again from 2015 to 2020 it can come down. So that is what they are observing as a part of the decennial pattern. And someone has come out with, I mean the person himself, is a quantitative wave theory, which is simply saying the whole economy moves in a cycle of 54 years. So probably you don't even find so many data points to observe and confirm also. Right? Probably within a century you will find only 2 full cycles. But from whatever data that is available, this is, so these are the 3 common cycles that are used in US. Where they have come out with Western economies, basically. This Western economy cycle is typically 54 years. So may not be applicable to our Indian scenario, but that is the observation that they have done on the economic cycles. So some of these, at least from a name standpoint, we have to be comfortable with. And this is one more. So in all these, there is a lot of research that has been done. But for us, we just need to understand the terminology and the basic stuff in this. Then there is one more concept that this chapter discusses, which is the Elliott's wave theory. It's a very interesting concept, again, from a simplicity standpoint. Let's say if something is going up, it says even if it falls, it does not fall. If it is in an uppish trend, though it falls by a small portion. Again it goes up. Again it may fall by a small portion. Again it goes up. So basically it's like 5 waves. 1, 2, 3, 4, 5. In case of upward trend, we see a typically 5 waves going up and 3 waves coming down. That's a typical uppish trend kind of a pattern. In a downward trend, he says 5 waves will be down and 3 will be up. And another interesting aspect that has been brought out of this is the ups like this. They would be following this Fibonacci sequence, Fibonacci number sequence. What that simply is telling me is, let's say the next up will be 3 by 2 times the previous up. So the next down will be 3 by 5 times the previous down. The next up will be 5 by 3 times the previous up. Right? So, but the good thing is, if you look at all, let's say I look at 8 by 5, 1.6, do a 13 by 8, the next one, 1.625, 21 by 13, 1.61. So it actually fluctuates around that 1.6 only. So what it says is, anything you take in Fibonacci sequence, 1.61, right? 34 plus 21, 55 by 34, 1.61. So what you see in a Fibonacci sequence is, any value you divide it at slightly higher values, the next value by previous value, it's almost 1.6 times. The previous value by the next value is 0.6 times. You do it the reverse. 5 by 8, 8 by 13, 13 by 21. You see almost 0.6. So what it says is, the next up, in case of uptrend, the next high will be 1.6 times the previous high, and the next low will be 0.6 times the previous low. That's the typical way the Elliott wave theory has been proposed. So these are all based on observations itself, and yeah, the everything is in the form of cycles. So he says a bigger cycle is called as a grand cycle, super cycle. So because you will find small movements, slightly moderate kind of movements, large kind of movements. So he talks about cycle, super cycle, grand super cycle kind of name to indicate. And he has brought out another synonymous thing there, connecting it to waves. He called them as waves, tides and ripples. Ripples are like very, within this short time frame, there could be so many everyday fluctuations. They are all called as ripples. Tides are more like once in a while, once in 15 days something will happen, or once in 30 days something will happen. They are like moderate kind of movement, right? Probably it's like this. Overall, I may see this kind of a cycle, but within this probably I may see something like this. These are like tides, these are like waves. These are like ripples. If you look at the actual price graph, it will be more like ripples itself. But if I look at it on a moderate scale and a large scale, big picture and a moderate picture, I'll see something like cycles and ripples and waves kind of stuff. That is what is the Elliott's wave theory all about. So from our exam standpoint, basic understanding on that Fibonacci numbers and what is that uptrend, downtrend, how did he define the uptrend and downtrend is something we have to be comfortable. And finally, in this chapter, there is a mention about if at all I want to do the comparison across multiple markets, not just within the stock market, commodities market, currencies market. If I have to do the same relative strength analysis, I have to do. Look at what is the index, commodity index versus stock price index ratio. Is that ratio going up? Is that ratio going down? If it is going up, that market is performing better to the other market. Otherwise, that market is performing worse to the other market. So, if at all I have to do inter-market kind of an analysis, the relative strength analysis itself is the most better tool in the aspect. So, the understanding of the technical analysis from our exam standpoint should be to that extent of basically why a technical analysis is required rather than a fundamental analysis. One chapter is the total focus. So why, in what cases we use technical analysis and what are the various terms that are being discussed. It's only to that extent because after this we don't have any more technical analysis in the next levels or wherever it is. Just that we need to understand a little bit more on it, because generally any trading or investment, probably if I know the whole scope, how the investors behave, what is the psychology of the various traders, only if I understand some of these things, probably you can do a better evaluation of the securities and better decisions can be taken. So from that standpoint, this chapter is introduced. So probably just a quick read through and solving some of the basic numericals at the end of the basic, not too many numericals also exist in this. Hardly for that 2 or 3 which I was talking of, the neckline versus the head in the head and shoulders, or probably the Elliott's wave theory, Fibonacci sequence kind of stuff. Except for those 1 or 2 small arithmetic kind of calculations, nothing more than that as far as this chapter is concerned. Right?